Dear students. So we are meeting again, and this time we will do the revision of a very important chapter from exam point of view as well as from practical point of view. So the chapter is assessment of trust and institution, political parties, and other special entities. Keep in mind, every year question is in every attempt question is asked from this chapter. So this is very important from exam point of view. And also, once you qualify, this chapter would have a lot of significance in your practice. Okay. So let's start with the charitable organization. Firstly, the Income Tax Act gives benefit to the trust or societies or Section 8 or 25 companies who are engaged in the welfare of the people, who are engaged in charitable activities or religious activities. So this one, such benefit is provided for two ways. So there are two regimes which are currently applicable, which gives a benefit to the entities to a trust engaged in charitable or religious welfare. So first regime is section 1023. So 1023C gives a benefit to this organization. And second regime is section 11 and 12. So there are section 11 and 12 which also gives almost a similar benefit to these types of organizations. So an assessee, a trust, may choose between 1023C or section 1112. Okay. But since it's a kind of duplication under the Act, so with effect from 1st October 2024, what the government has said that, what the government has did that, they have tried to discontinue section 1023C exemption where the approval was required. So a new clause has been inserted which says that no fresh application can be filed seeking an approval under section 1023C on or after 1st October 2024. So whoever trust or societies, they have registered under section 1023C, they should continue to claim exemption under such section till the time the registration is active. But if the registration expires, then they have to move to the second regime, section 1112, because after 1st October 2024, no fresh application for approval under section 1023C can be filed. And if the application was filed on or before this 1st October 2024, then such trust, then the order shall pass under this section 1023C only, and the trust shall avail the exemption under this section, but only up to the expiry of such registration. Once such registration expired, the new registration can only be obtained under section 11 and 12. See what happened under section 1023C. There are many clauses. We will study in a minute. So some clauses require approval and some clauses doesn't require approval. So we are talking about the clauses where the trust is required to get approved under section 1023C to claim the benefit of section 1023C. There are some clauses where the trust is not required to get the approval from the income tax department and still they can get the benefit of section 1023C. Okay, so this much clear. What we discussed is there are two regimes, 1023C and 1112. But a sunset has been imposed on 1023C in respect of trusts which seek approval under section 1023C. So no fresh application can be filed on or after 1st October 2024. Okay. So this we just discussed, it is written here. Charitable or religious trust or institution can avail income tax exemption under two different independent regimes. They are independent. They are not related to each other. They are not dependent on each other. So they are a self-code in themselves. Section 1023C and section 1112. So first regime pertain to exemption available under section 1023C. which exempt income received by any person on behalf of university or other education institution or hospital. The second regime pertain to exemption of section 11 that provides for exemption in respect of income derived from property held under trust wholly for charitable or religious purposes. See, application for approval or renewal or approval under first regime cannot be made on or after 1st October 2024. Consequently, with effect from 1st October 2024, trust or institution desirous of availing exemption shall make an application for registration under second regime only. So there's a mandatory shift for the trust or institution from 1023C to section 11 and 12, the second regime. It is important to note that trusts which were approved or made application before 1st October 2024 got approval thereafter are eligible to claim exemption under the first regime till the validity of such approval. So they can continue to claim the exemption under the first regime till their approval is valid. Once the approval expires, they have to move to the second regime. Okay. See, there are two types of trust. One is public trust and another is private trust. Public trust means the trust where the beneficiaries are public at large. Private trust means the beneficiaries are not the public. Okay. Under section 1023C or 11 and 12, the benefit is given only to the public trust. Because the beneficiaries are the person for whom benefit the income from the property held under trust shall be utilized. So the assumption, the benefit and income is given only to the trust where the beneficiaries are public at large. So now we start with charitable religious trust. Okay, this is the broad structure of section 1023C. It has many subclauses: 3AB, 3AC, 3AB, 3AE, 3AB, and 3AC. It says that if the assessee is engaged into education or medical, then whole of the income shall be exempt under section 1023C if the assessee is substantially financed by the government. And in this case, you don't require any approval. Similarly, if your aggregate receipt during a previous year is up to 5 crore, aggregate annual receipt, then also you don't need any approval. You need approval only if you are not either substantially financed by the government and your annual receipt exceed rupees 5 crore and or you're engaged in any other charitable religious purpose. Okay. So this automatic this point that the approval is not required is applicable only for education and medical institutions. Okay. Now, what do you mean by wholly or substantially financed by the government? It means that at least 50% of the total receipts during a year should come from the government. So that if the government grant to a university or other education institution, hospital or other medical institution during the relevant previous year exceed 50% of total receipts of such university, hospital, medical institution, or education institution, as the case may be, then such university shall be considered as being substantially financed by the government. So you understand? When we talk that if an education institution or a medical institution is substantially financed by the government, we mean the government grant exceeds 50% of total receipts of such institution. In such case, there is no requirement to get the approval and it can claim the benefit section 1023C. What is the benefit? Benefit is that whatever income you receive, you will allow the deduction of the amount of income you apply for your object, and you only need to apply 85% of such receipt. 15% of the receipt is allowed to be accumulated indefinitely. Okay, so this is the big assumption. Now, second set of institution was, one set of education medical institution was who are substantially financed by the government. Second set of institution was where the annual receipts does not exceed rupees 5 crore. Okay. Now you have to see this 5 crore qua assessee, not qua institution. I mean, if there is a If there is a assessee A, it has education institution and medical institution, a hospital. The annual receipt of education is 3 crore and medical is 4 crore. Then he is not eligible for 1023C because we have to see the aggregate. And aggregate is exceeding 5 crore, and therefore he has to seek the registration. He cannot take the benefit without registration. Okay. C, where a person has received from an institution specified in subclause 3AD as well as from an institution specified in section 3AE. It is education and it is medical. Okay. Whose combined receipt exceed 5 crore. So we have to see the combined receipts. When the combined receipt exceed 5 crore, the said person shall not be eligible for the exemption because we have to see the combined receipt. And if the combined receipt exceeds the threshold of 5 crore, then the benefit of exemption under such law is not available. Benefit available only if the combined receipt is up to rupees 5 crores. And for the rest of the institution who are required to get the approval to take the benefit, they can make an application for the approval only on or before 1st October 2024. They could have made. Okay. So now 1023C is active, but only for this organization in respect of the period for which their approval registration is valid. Once the approval expires, whatever date it expires, then after that, these institutions have to mandatorily shift to the second regime of section 11 and 12. See, there's a question. An education institution having annual receipt of rupees 3.8 crore during PY 25-26 has availed exemption under section 1023C 380. Okay. So there was education institution, his receipt was only 3.8 crore during 25-26 and therefore claim exemption. The AO, assessing officer, had denied the exemption on the ground that education institution has not made any application to the prescribed authority for approval under section 1023C38. So the AO has given the opinion that exemption should not be available because the trust has not applied for the registration. Examine the action of the AO in denying the exemption. Tell me whether AO is right in denying the exemption or not. The answer is no. Why? Because it is an education institution and the annual receipt is less than rupees 5 crore, is up to rupees 5 crore, and therefore is not required to get the mandatory registration. It can claim the exemption without the approval. So action of AO is not correct. Okay. A not-for-profit trust undertakes philanthropic activities through an education institution and a hospital. Okay. So there's a trust which has an education institution and also a hospital. Okay. During the previous year 25-26, the trust had annual receipt of 3 crore from education institution and 4 crore from a hospital. So the receipt was 3 crore from the school education institution and 4 crore from the hospital. During PY 25-26, it desired to avail exemption of section 1023C 3AD and 3AE as the individual threshold under each of the subclause is less than 5 crore. So what is the view of the assessee? That since the individual threshold of education institution and hospital is less than the threshold of 5 crore, prescribed threshold 5 crore, therefore it is eligible to take the benefit section 1023C even without registration. But the view of the assessee is wrong because we have to see the aggregate. We have to see the assessee wise, not the institution wise. So assessee is the trust. So we have to see the aggregate receipt of the trust, which is 3 crore plus 4 crore equal to 7 crore. And since aggregate exceeds the threshold of 5 crore, it is not automatic eligible for exemption section 1023C. Since in the present case, aggregate annual receipt of 7 crore exceeds threshold of 5 crore, exemption under section 1023C 3AD and 3AE cannot be availed, even though individual receipt from education institution and hospital have not accepted. So we don't see the individual receipts, we see the aggregated receipts. Now we move to the second regime, section 11 and 12. Okay. So the first regime, the provision of section 1023C, primarily more or less are similar, identical to the provision of section 11 and 12. So whatever benefit or the condition imposed by section 11 and 12 are also imposed by section 1023C. So we'll study taking the base as section 11 and 12. Okay. So firstly, it says that income of charitable trusts. So how the income of charitable trust is computed? First, we take the gross receipt, the income from property held under trust for charitable or religious purposes. Okay. If such income is applied for the following income shall not be known. If such income is applied for the object of the trust, which is charitable or religious in nature, then whatever income so applied shall be allowed as deduction. Okay. So it says following income shall not be included in the total income of the previous year of the person receipt of income. What? The income derived from property held under trust only for charitable religious purposes to the extent such income is applied in India for such purpose. Okay. So whatever income you have received, if to the extent of the income you have applied such income for your object, which is charitable religious purpose, then the income to the extent it is applied shall be allowed as deduction, shall not be taxable. Okay. But you are required to apply only at 85% of the income. The 15% of the receipts or the income from the property is allowed an ad hoc deduction and allowed to be accumulated indefinitely. Okay. But if you see, it says the deduction is allowed only if the income is applied for such purpose in India. If I apply my income outside India, whether I'm allowed to claim the deduction in respect of the amount so applied? So answer is no. You can claim the deduction only if such income shall be exempt. Which income? The income applied for such purpose outside India shall be exempt, provided it is applied for the international welfare in which the India is interested. And secondly, the trust is charitable organization, not the religious one. And lastly, the trust has to seek approval from the CBDT before applying. So it says income derived from property held in trust for charitable purposes. It doesn't say religious purpose. Only for charitable purpose which tend to promote international welfare in which India is interested. To the extent to which such income is applied for such purpose outside India. If you apply such income in India for your object, then no problem. The such income to the extent applied is exempt. If you want to apply the income outside India, so first you have to be charitable organization. It's not allowed for religious organizations. Secondly, the even where you are applying the income, the international welfare should be such in which the India is interested. And lastly, the CBDT should have by general special order directed that such income shall not be included total income of the person in receipt of such income. Okay. So earlier, if the application is in India, you don't need any order from CBDT. But if the application is outside India, you need a specific order from the CBDT. And the assumption is provided where you have received any voluntary contribution. And such contribution is made with a specific direction that they shall form part of corpus of the trust. So we're talking about corpus donation. If a trust has received corpus donation, then such corpus donation are not taxable or exempt. Okay. So we talk about three exemptions. One, any income which has been applied for charitable or religious purpose in India, blanket exemption, no approval required. Then any income which is applied for charitable religious purpose, international welfare, not religious purpose, for charitable purpose, international welfare to which India is interested, provided you have a specific, special or general order by the CBD. Okay. And third, the voluntary contribution received with a specific direction that they shall form part of corpus of the trust. I mean, the corporate donation shall not form part of total income of the trust. They are exempted. Okay. Now, Section 12 says any voluntary contribution received without such direction means we are talking about non-corpus donations. So, any voluntary contribution received by a trust for the to be deemed to be income derived from property held under trust wholly for charitable religious purposes. Okay. So, if you have property, if you are earning an income from such property, it shall be deemed to be it shall be income from the property held under trust for charitable religious purpose. But if you have received any voluntary contribution, then such voluntary contribution shall also be deemed as income from property held under the trust. Okay? Okay. I explain in a more simple manner. So, what section 11 says, if you have income from property under trust, who is you? You is a trust who is fully for charitable or religious purposes. Income from property, income from property under trust, held under trust. Then such income is exempt if it is used for such purpose in India or outside India. But for outside India, you need an order from approval from CBDT, right? Now we talk about the voluntary contribution. So voluntary contribution are two types: corpus or non-corpus. By corpus, I mean the donor has specifically given direction that they should form part of the corpus of the trust. Or non-corpus means they have received without any such direction. The corporate donations are exempt, and non-corpus donations are treated as income from property held under trust. So they shall be exempt if they are applied to the extent they are applied in India or to the extent they are applied outside India with the approval of CBDT. Understood? So this is the whole reading of section 11 and 12. Now, the law discourages a trust to give a benefit to some specified person. Who a specified person? The specified person are the person who can influence. So they are trustees, author, founder of the trust, or a person who has given substantial contribution to the trust, etc. Okay. So since that person should not enjoy the income of the trust, so the Income Tax Act discourages a trust for giving any benefit to these type of people. But if any medical or education benefit is given to these type of people, then the value of such benefit shall be deemed to be the income of the trust, and such income shall be chargeable to tax in the hands of the trust. Okay. Now we are talking about charitable purpose. What is it? Do you mean by charitable purpose? So defined under section 250. It says charitable purpose includes relief to poor, education, yoga, medical relief, the preservation of environment, which includes preservation of watershed, forest, and wildlife, and preservation of monument and place or object of artistic or historical interest, and advancement of any other object of general public utility. So these six clauses are there, which are defined as charitable purpose. So first education, then there's a medical, then relief to poor, then yoga, preservation of environment, and preservation of monument or places of historical importance. Okay. And then lastly, advancement of any other object of general public utility. Okay. But since the last clause is quite wide, the first five clauses are very specific: education, medical, relief to poor, yoga, and preservation. Okay. Of environment or the historical places. But the last clause says advancement of any other object of general public utility. It's very wide. So the law has imposed some restriction on this clause. And what are the restrictions? It says the advancement of any other object or general public utility will not be a charitable purpose. So the law will not treat this object as a charitable if it involves the carrying on of any activity in the nature of trade, commerce, or business, or any activity for rendering any service in relation to any trade, commerce, or business. So, in the disguise of promoting any other object general public utility, if the trust is engaged in any activity in the nature of trade, commerce, or business, then it shall not qualify as a charitable purpose. However, and this is irrespective of the use or application of income from such activity or retention of such income by the concerned entity. So even if the income from such business, such trade, commerce, or business activity is applied for the charitable purpose, for other charitable welfare, still such object shall not be treated as a charitable purpose. So fact, the fact that the income is applied for charitable purpose is not relevant. The utilization of income generated from this activity is not relevant. The fact that the trust is engaged in any activity in the nature of trade, commerce, or business, it is not eligible as its activity cannot be said to be a charitable purpose. However, a small benefit is given that you can engage in trade, commerce, or business if such activity of trade, commerce, business is undertaken in the course of actual carrying out of such advancement of general public utility, and the aggregate receipt from such activity of trade, commerce, or business during the previous year does not exceed 20% of total receipts of the trust or institution undertaking such activity for the previous year. Okay. So firstly, it says charitable purpose has 6 clauses. The first 5 clauses are straightforward: education, medical, yoga, preservation, and relief to the poor. Okay. But if the 6th clause, the advancement of any other object general public utility, it has a proviso. It says that if such object involves any activity in the nature of trade, commerce, business, then irrespective of the utilization of such amount, the fee received from such trade, commerce, business, the trust shall not be said to be a charitable purpose. However, a small benefit is given that such activity is permissible if they are carried out in the course of carrying out such advancement of object of another general public utility, and the total received from such activity is up to 20% of the total received by the trust. Okay. So kindly keep in mind the fact that the trust cannot engage in trade, commerce, or business is relevant only in respect of this clause, last clause, which is advancement of object or another object of general public utility. In respect of first 5 clauses, there is no such condition. Even if they are taking some fees or receipt, still they are eligible for the charitable purpose. See, if we see question number 3, an institution having its main object at advancement of general public utility. The institution is covered by the last clause, received 30 lakh in aggregate during 25-26 from an activity in the nature of trade. So the institution is engaged in the nature of trade. Okay, and it has received 30 lakh. So firstly, a point clicks in our mind that this is not permissible. But then we say it is permissible provided such activity of trade is in the course of carrying out the object of general public utility, advancement of the object of general public utility, and the receipt should not be more than 20% of total receipts. Okay. The total receipt of the institution, including donation, was 140 lakh. The total receipt was 140 lakh, and receipt from the trade is 30 lakh. So 20% of 140 lakh comes to 28 lakh, right? Yes. Since the receipt from trade is more than 20%, such entity shall not be eligible for exemption of section 11 and 12. It applied 85% total receipt from such activity during the same year for its main object, advancement of object general public utility. The question says it has the entity, the assessee has applied 85% of the receipt for its object. But we know the utilization is not relevant. If the receipts exceed 20% of the total receipt, then you are not eligible for the benefit. What would be the tax consequence of such receipt and application thereof by the institution? So the institution is not eligible for benefit in section 11 and 12. Okay. Would your answer be different? The institution total receipt had been 150 lakh instead of rupees 140 lakh in aggregate. So had my receipt been 150 lakh, then 20% 150 lakh is 30 lakh, and the receipt from trade is up to 30 lakh. So it is within the threshold, and I shall be eligible for the exemption of section 11 and 12. What will be your answer? If the main object of the institution is relief of poor, and the institution receives 30 lakh from a trading activity, when its total receipts are 140 lakh and applies 85% of said receipt for its main object. Now the question says, similar to part 1, so my receipt from the trade is 30 lakh, total receipt is 140 lakh. But now I am not registered as another last clause of advancement of any other object general public utility. Rather, I am registered as a relief to poor. And you remember we discussed that this condition that the assessee should not be engaged in any activity of trade, commerce, or business is relevant for the last clause, advancement of any other object general public utility. It's not relevant for the first 5 clauses. Relief to poor comes under first 5 clauses, and therefore, even in this case, the receipt from trade exceeds 20% of the total receipt. Still, the entity shall continue to be charitable purpose and shall be eligible for the benefit. Okay. So, example in part 1, the institution will lose its charitable status and consequently the benefit of exemption for PY 25-26, irrespective of the fact that is approved, is not withdrawn registration, is not cancelled. So it will lose its benefit of exemption because the receipt from trade exceeds 20% of the total receipt. However, in this case, the institution, if the receipt is up to 20%, the institution can claim the exemption. Okay. Lastly, where the institution is registered under head relief of poor. In such case, even if the receipts from trading activity exceed 20%, still the exemption is available. The restriction regarding carrying on trading activity for cess fee or other consideration will not apply if the main object of the institution is relief of poor. It's apply only if the main object is advancement of object of general public utility. There were 30 lakh from a trading activity by such institution will not affect its charitable status even if it exceeds 20%. Okay. So next question is Save Wildlife, an institution having its main object as preservation of wildlife. So you remember preservation of environment includes preservation of wildlife and forest. Okay. It's one of the clause of charitable purpose. Used the entire income derived from an activity in the nature of trade for its main object during the previous year. So it's also carrying an activity in the nature of trade and has used the income from such activity for its object. Okay. Would such utilization of its income be treated as utilization for charitable purpose? Examine. Would your answer be different? The main object was advancement object of general public. So we just discussed this that that the restriction that you cannot do the activity of trade is applicable only if you are registered, if your object is general public utility. If you are registered, if your main object is any of the first 5, then this conditional that you cannot engage in trading activities is not relevant. Okay. So long as the trust is registered with the object of preservation of wildlife, even if it's doing a trading activity, is having a receipt from the trade, still it is eligible for the exemption. However, if the object of the main object of the trust is general public utility, then it will lose its charitable status and shall not be entitled to the exemption if the total receipt from the trading activity exceeds 20% of the total receipt of the trust. Okay. Preservation of wildlife is included in definition of charitable purpose. Further, an institution having preservation of wildlife as its main object would not be subject to restriction which are applicable to the advancement of any other object of general public utility. Such institution would continue to retain its charitable status even if it derives income from activity in the nature of trade. However, if the institution has a main object to be advancement of another object, general public utility, derives income from an activity in the nature of trade during a financial year. It will lose its charitable status even if it applies such income for a charitable purpose. The application of such income is not relevant. What you have to see, so if we summarize, if the main object is out of this five, education, medical, relief to poor, yoga, preservation, then even if you have an activity in the nature of trade, still you will continue to claim the exemption, to have the benefit of the exemption. Okay. You will continue to have a charitable status. But if your main object is the residual object, which is advancement of any of the object of general public utility, then you cannot engage into any activity in the nature of trade, commerce, or business. You can engage in such activity provided such activity is carried out in the course of advancement of any of the object of general public utility, and receipt from such activity is up to 20% of total receipt of the institution. Okay. Now, there comes the interplay between the charitable organization and a mutual concern. In the last class, yesterday, we discussed about the mutual concern. Who are the mutual concern? Mutual concern means the concern where there is a similarity of contributor and participants. Okay. So, they are members of the concern who are contributing to the concern, and the concern is working for the welfare of its members. So long as the concern is only dealing with the members, it is not required a benefit in section 11 and 12 because the income of the concern shall be exempt on the principle of mutuality. However, if it is dealing with non-members, then you have to see its activity so as to see whether it qualifies for exemption or whether the activities qualifies charitable under section 215 or not. Okay. So this is what the CBDT said, where industry or trade association claim to be both charitable as well as mutual organization, and their activity are restricted to contribution from and participation of only their members. So the activity are restricted to their members, then they will not fall within the purview of the proviso to section 250 owing to principle of mutuality. So we will not see that, we will not say that to engage in trade, business, or commerce. However, if such organization have dealing with non-members as well, then claim a charitable organization will be governed by the provision section 215. Okay. Now the CBDT has clarified that if the entities engage in promotion of sports or games, then such object of the entity is considered to be charitable purpose with the meaning of section 215, and such entity shall be eligible for the benefit of section 11 and 12. Okay. Now, if the charitable organization is engaged into trade, so can charitable organization engage into trade? Answer is yes. We just discussed. See, there is no restriction. These five trusts whose main object is relief to poor, education, medical, yoga, preservation, so they can engage into trade. And even the organization having the main object as general public utility can also be engaged into trade provided the activity of trade is carried out in the course of advancement of such object, and receipt from such activity is up to 20% of the total sales. Okay. Now we understood that the institution can engage into the activity in the nature of trade, commerce, or business. But if the institution is so engaged, then it says that how to compute the income. It says that income from such trade or business shall also be deemed to be the income of property held under trust and shall be eligible for exemption if such business is incidental to the main object, to the attainment of the object of the trust, and separate books of accounts are maintained by the institution of the trust in respect of such business. So there is only two conditions. The exemption would be available in respect of income being profit from gains from business activity if such business is incidental to the main object and the assessee maintains separate books of account in respect of such business. However, if at the time of assessment, assessing officer derives an income from such business more than the income shown in the books of account, then the excess amount so computed by the assessing officer shall not be eligible for the exemption. So it says the AO shall have the power to determine the income of the undertaking in accordance with provisions of the Act, and where the income determined by the AO is in excess of that shown in the books, the excess shall be deemed to have been applied for purpose other than charitable or religious purposes. Meaning thereby, the excess shall not be eligible for exemption under section 11 and 12. Okay. So, first we discuss that can a charitable organization be engaged into the activity of trade, commerce, or business? Answer is yes. There is no restriction qua the five entities having the main object among any of these five. And if you have a residual object, still you can engage into the trading activity in the activity in the nature of trade, commerce, or business, provided such activity is in the course of carrying out the main object of general public utility, advancement of object of general public utility, and receipt from such activities up to 20%. If the organization is so engaged, then the income from the business shall be exempt, provided one, such business is incidental to the main object, and separate books of accounts are maintained by the assessing inspector of such business. However, if during the course of assessment, the tax officer computed the income from such business more than the income which is disclosed in the books of account, then the excess amount shall not be available for exemption and shall be deemed that such excess has been applied for purpose other than charitable or religious purpose. Okay. Now let's see one institution. MSN, a charitable educational trust. Okay, so trust is educational. It's coming under the first five clauses. Approved under section 1023C, 6, okay. Is running a school, it operates a stationery shop outside the school campus. So it's carrying on an activity in the nature of trade for which it is charging fee or the consideration. But since the education institution, there is no restriction, it can. And such income shall also be exempt. Income from this stationery shop shall also be exempt, provided it is incidental to the main object and separate books of accounts are maintained. So for a school, running a stationery shop is incidental, and if SSC maintains separate books of account, the income from this stationery shop shall also be exempt. So a sum of 75 lakh has been derived as net income from such business activity. So during the previous year, the SSC has derived an income of 75 lakh from the stationery shop, which has been applied to the object of the trust in providing education. So whatever income it has derived from the stationery shop, it has utilized it for the main object. The trust maintains separate books of account for the business activity. They maintain separate books of account. So both the conditions are satisfied. It is incidental to the main object and separate books of accounts are maintained. So this income of 75 lakh shall be exempt. Examine the taxability of application of income if income so derived relates to the previous year 25-26. So it says the profit from business shall be eligible for exemption, assuming that the said business is incidental to the attainment of the object and books of accounts of business is maintained separately. Okay, simple. So we discussed what all are exemption. The exemption are in respect of the income applied in India for charitable religious purposes, income applied outside India in the international welfare to which India is interested, and such application is approved by the CBDT. Thirdly, voluntary contribution received with a specific direction that they shall form part of corpus of the trust, meaning corporate ownership. So these three income are exempt. Okay. Then we saw that income from business undertaking is also exempt, provided the business is incidental and separate books of account are maintained, and such income is utilized for the main object of the trust. Okay. Now, what are other conditions for availing this exemption? So one of the important condition is the registration. So trust has to be registered for claiming this exemption. Now, earlier before 1/4/2021, the registration was given for perpetuity. So once the trust is registered, it is registered. It need not require the registration certificate did not have a validity clause. You don't have an expiry date. Okay. But from 1st July 2021, the law has been amended and says that the trust has to apply for registration, and such registration shall be given for a specified period of time. It may be 5 years, maybe 3 years, or maybe 10 years, as the case may be, which we study. So, if you are a registering trust and you were already registered on or before 1st April 2021, then you must apply for registration. The application should be made within 3 months from 1st April 2021, meaning thereby by 30th June 2021. Once such application is made, the trust is registered by the Commissioner of Principal or Principal Commissioner. Okay. Once such application is made, the Commissioner has to pass an order within 3 months from the end of the month in which the application was made. Okay. And the Commissioner may allow the registration, may give the registration, or may reject the application. The registration is given, the registration shall be valid for 5 years. However, if you are a small trust, meaning if your profits, if your income for the last 2 years is less than 5 crore, then the registration shall be given for a longer period of 10 years. But if your income is more than 5 crore, then registration shall be given only for 5 years. Okay. If you are already registered and your registration get expired, as you know, the registration given for 5 years or 10 years. So when it expires, you have to reapply, and you have to reapply within at least 6 months prior to the expiry of the registration. And once you reapply, the Commissioner shall pass an order within 6 months from the end of the quarter in which application was received by him. He may accept the registration or he may reject the application. But before rejecting, he has to give the opportunity of bringing her to the assessee. Okay. Here also the registration, if given, shall be given for 5 years. But if you are small trust, meaning your income for the last 2 years less than 5 crore rupees, then the registration shall be given for 10 years. If the trust was earlier provisionally registered and now you want to go for the regular registration, then you have to apply for the registration at least 6 months before the expiry of this provisional registration, or 6 months or within 6 months of the commencement of the business activities. So whichever is earlier, you have to apply. And once apply, the Commissioner shall pass order within 6 months from the end of the quarter in which the application is received by it. It may accept or it may reject. If it accepts, then the registration shall be valid for 5 years. But if you are a small trust, then registration shall be valid for 10 years. Small trust means your income for the last 2 years up to rupees 5 crore. See, we'll discuss in a minute that registration already given to a trust may become inoperative. And in such case, the trust may again apply to make the registration operative. If such is the case, then the application is made under cross code, and such application should be made at least 6 months prior to the commencement of assessment year from which the said registration sought to be made operative. So you have to apply at least 6 months before the year for which you want to seek the registration. Okay. Similarly, the order shall be passed within 6 months from the end of the quarter your application is made, and the registration shall be granted at least for 5 years. It can be for 10 years if you are a small trust. If the trust has modified or amended its object on the basis of which it was registered, then it has to apply for registration. The application shall be made within a period of 30 days from such amendment. And other 2 points are similar. The CIT or the PCIT shall pass an order within 6 months from the end of the quarter in which the application is so received by them, and the registration shall be for 5 years or 10 years as the case may be. In any other case, meaning you are a new trust. So your new trust, you will first be allowed a provisional registration if your activities have not yet commenced. And such registration is valid for only 3 years. And while giving provisional registration, the CIT cannot make any detailed inquiry. While giving the regular registration, which we just discussed above, the CIT can call for the information to satisfy himself about the genuineness of the activity and compliance of any other law. But if you apply for provisional registration under clause 6, then it is almost automatic and and it is given only for the 3 years. Okay. You have to make an application for provisional registration at least 1 month before the commencement of the previous year for which the provisional registration is sought. Okay. If you're a new trust and you have not applied for provisional registration, but you have commenced your activity, then you need not to go for provisional registration and then getting it converted into regular registration. You can straight away go for the regular registration. Okay. If the activities have already been commenced. The law gives the power to CIT or PCIT to condone the delay in making the application. So the SSC has delayed in making the application of registration, then the CIT has the power to condone such delay to the if it is satisfied that delay is genuine. And if the delay is condoned, then shall be deemed that application was filed within time. Okay. Now let's see a simple question. A public trust has commenced its activity for providing relief to poor in the year 23-24. Trust intend to claim benefit of section 11-12 for AY 26-27. Okay. The activities was started in year 23-24. Now they want to claim the benefit in AY 26-27. It approaches you in October 25. The total income of the trust for 23-24, 24-25 was this and this, 20 lakh and 45 lakh respectively. Advise the trust as to the time limit for making an application for registration, time limit for granting the approval by principal commissioner or commissioner, and period for which approval is granted. Okay. So trust has already commenced the activity. It need not to go for the provisional registration. It can straightway go for the regular registration. Okay. So the application has to be made at least 6 months before the assessment year for which it want to claim the benefit. Okay. So it has approached you in October 25 and wants to claim the benefit in AY 26-27. So you can file the application in October 25. It's well within the time. And lastly, and the commissioner has to pass the order within 6 months from the end of the quarter in which the application is received by it, and the registration shall be valid for 10 years. Why? Because the income of the trust in the last 2 years is less than 5 crore. Okay. So it says grant registration within 6 months from the end of the quarter in which application was received. Validity of the registration is valid for 10 years. Why 10 years? Because it's a small trust. His income is up to 5 crore. Help on. A trust created on 1st April 2024 for providing relief to poor. Applied for registration section 12 AB on 28th Feb 2025. Okay. The commissioner denied registration on the ground that trust had not commenced any charitable activity due to which he could not satisfy himself about the genuineness of the trust. So what the commissioner said that I will not give you registration because you have not yet commenced any activity and therefore I cannot satisfy myself about the genuineness of the activity. So is it right? Is the ground of denial of registration by the commissioner is justified? The answer is clearly no, because the law itself says if you are a trust and if you have not commenced any activity, you can go for provisional registration. And in case of provisional registration, the commissioner is not required to do a detailed inquiry. So provisional registration is given only for 3 years. Then in such case, the trust has to apply for the regular registration at least 6 months before the expiry of provisional registration or 6 months within the commencement of its activity, whichever is earlier. Now, once the trust is registered, can the registration can be withdrawn? Can the registration can be cancelled? So answer is yes. There are 3 circumstances where the registration can be cancelled. 1, if there is occurrence of any specified violation, which we'll discuss. 2, if during the course of assessment, the assessing officer under section 143(3) refer this matter to Commissioner for checking whether the registration should be cancelled or not. And if in such in such procedure, the Commissioner finds that activities are not genuine, then it can cancel the registration. And lastly, if the case of the institution selected under the risk management strategy formulated by CBDT from time to time. So in these three situations, the registration can be cancelled. You see, the situation does not include where if the trust is registered under the last clause, residually clause, advancement of object of general public utility, and if in any year is received from the trading activities exceed 20%, then in such case registration is not withdrawn. But for such year, you will not be eligible for the exemption. Okay. This order of cancellation of registration has to be passed before the expiry of 6 months from the end of the quarter in which the first notice is issued by the PCRE to the assessor. Now, what are the specified violations which can give rise to the cancellation of the registration? So first is where the income of derived from the property held for charitable purposes has been applied other than for the object, or where the institution has income from PGB, profit of business undertaking, but either the business undertaking is not incidental to the main object, or separate books of accounts are not maintained by such trust in respect of such undertaking, or it has applied its income for any part of income for private religious purposes which does not inure to the benefit of public at large, or the trust has applied any part of its income for the benefit of any particular religious community of caste, not to the all, but only a particular religious community or a caste, or an activity is carried out by the trust is not genuine or not being carried out in accordance with the or any of the conditions subject to which it was registered, or it has not complied with the requirement of any other law which is applicable to it. Okay. And then lastly, the application for approval under first regime of registration, second regime contain false or incorrect information. If you got the registration basis the incorrect information and subsequently the department found out the information was incorrect, then also your registration can be withdrawn. Okay. So if you applied your income for any purpose other than your object in respect of business undertaking, either the undertaking is not incidental to the main object, or you have not maintained separate books of account, or you have applied the income for private religious purpose or for the benefit of any particular religious community or caste. In all these cases, registration can be cancelled. Or if it is found that your activities are not genuine or activities are not in accordance with the condition subject to which registration was given, or you have not complied with the requirement of other law, and lastly, if the registration was obtained on the basis of false information. In all these cases, the registration can be withdrawn. So first condition to claim the exemption is that you must be registered. Second, you must furnish your return of income. Okay. The requirement to furnish return of income arises when your gross receipt without the exemption of section 11 and 12 exceeds the maximum amount not chargeable to tax. The return of income is to be filed in time allowed under section 139(1) or 139(4). Be late, remember. If total income without giving effect to the provision of section 10 or 11 or 12 exceeds the maximum amount is not chargeable to tax, meaning that exceeds the basic exemption limit. Okay. Third condition, you are required to maintain books of account and get them books of account audited. Okay. Your total income of trust exceeds, without giving effect to the provision of section 10, 11, and 12, exceeds the maximum amount not chargeable to tax, then such entities shall keep and maintain books of account and get the accounts audited by a chartered accountant. Okay. The audit report is furnished in either Form 10B or Form 10BB. So Form 10B is for the bigger trust, larger trust, and Form 10BB is for the smaller trust. So Form 10B is applicable if the income of the trust exceeds by 5 crore, or there is any foreign contribution, it has received some foreign donation, or the trust has applied its income outside India. In any of these three cases, if your income is more than 5 crore, or you have any foreign donation, or you have applied income outside India. In any of these three cases, you have to file Form 10B. In any other case, you have to file Form 10B. Meaning, if your income is less than 5 crore, then you are required to file only Form 10B. The difference is Form 10B is quite big, quite large. It asks for more information, and 10BB is smaller because it deals with the small trust. Okay. Okay. These books of account are required to maintain for at least 10 years from the end of the relevant assessment year. However, if any assessment has been opened, then the books of account for such year shall be maintained till the time such assessment has become final. Now, we said that the trust is required to apply at least 85% of its income to claim the full redemption. Okay. Now, it may happen that it is not able to apply the entire 85% for some reason. The reason may be the income is not received during the relevant previous year, or income is received on the last day of the previous year. How can I apply? In such case, the law gives you an option. You can apply for accumulation of the income. So what the law says, if you have not received income during the previous year, no worries. You apply for an option and said that you will apply this income in the year of receipt or in the immediately succeeding year. Then it will be deemed that you have applied this income during the relevant previous year. Similarly, if income is received on the last day of the previous year, then the law gives you an option that you can apply for the accumulation and say that I will apply this income in the succeeding year. Then it shall be deemed that you applied the income in the relevant previous year. But in the year in which the income is actually applied, it shall not be considered as application of such year. Logical? It says where the whole or part of the income has not been received during the year, previous year, the period of application is extended to cover the previous year in which income is actually received and previous year immediately following that year. Okay? Or in the second case, the period of application extended to the previous year immediately following the previous year in which the income was derived. Okay? So it says in the trust, you have to apply at least 85% of your receipts, of your income. Right? But if income is not received in PY 25-26, no worries. You can apply it in the year of receipt or subsequent year. Say it is received in FY 28-29. Then you can apply in 28-29 or 29-30. In such case, it will be deemed that you have applied it in the year 25-26 itself. But in the year 29-30, wherever you have applied this income, it shall not be treated as an application in such year. So you can treat application only once. We have treated it as an application in the year in which income is derived, which is PY 25-26. Then again, in subsequent year, we cannot treat it as an application of such year. If the income is received on the last day, then you can apply it in the succeeding year, meaning 26-27. Then we will deem that you have applied it in the relevant previous year, 25-26 itself. But in such case, the application of income in year 26-27 shall not be considered as application for such year. Clear? It says, a simple question. During the previous year ending 31st March 2026, a charitable trust earned an income of 1 lakh, but it received only 60,000 in that year. So it can accumulate 40,000 and say that I will apply it in the year in which I will receive or immediately succeeding year. The balance 40,000 received during the previous year 26-27. Okay, so next year. So total income during PY 25 is 1 lakh. 15% is ad hoc transaction allowed. I need to apply only 85,000. Out of this, I will accumulate 40,000 and apply 45,000 only. And for this 40,000, I can need to apply it in the year of receipt or succeeding year. So I can apply this 40,000 into this 27 or 27, 28. Okay. For accumulation, the trust has to file a form with the assessing officer, which is judicial assessing officer, that it will apply the income in the year receipt or succeeding year. And such form has to file at least 2 months before the due date of furnishing return of income under section 139(1). In such case, the income so deemed to have been applied shall, however, not be taken into account in calculating the amount of income applied for such purpose. Okay. During the previous year in which income is actually received, or during the immediately following previous year, as the case may be. Amount not treated as application. So if you incurred any amount for these purposes, it shall not be treated as application of income for charitable religious purpose. Okay. So the benefit of section 11 and 12 shall not be available to these applications. One, amount credited or paid out of income of the trust by the corpus donation not to be considered application. If the assessee trust has given any corpus donation to the another trust, then the trust which is giving the donation shall not be eligible to claim the exemption. This corpus donation is exempt in the hands of recipient, but the payer is, if the payer is the trust, then such payment shall not be treated as application in the hands of the payer. Okay. In the hands of the recipient is exempt, but for the payer, it shall not be deemed as application. Only 85. So even if you have given a donation other than the corporate donation, then also whatever amount you have given, only 85% of such donation shall be treated as application. Even if you've given the entire 100% of your receipts, still we will treat only 85% of the payment as your application. Okay. But in such case, you are not required to accumulate the remaining 15% because you don't have money. You have already given the entire thing as a donation to another trust. But this donation, other than the corporate donation, can be made only from the income of the current year. It cannot be made from the accumulated income. So amount credited or paid out of accumulated income of any trust to any trust institution registered under section 12A or 1023C, not considered application of income. So firstly, it says, if the assessee has given corpus donation, we will not treat you as a application. Then you have given a non-corpus donation. Then firstly, it should be from the income of the current year. If it is from the income of the current year, I will treat only 85% of such payment as application. And if it is not from the income of the current year, then exemptions shall not be allowed. If it is from the accumulated income, it is not allowed. Okay. While computing the income of the trust, the TDS provision and provision restricting the cash payment is applicable. So it says, provision section 40A IA, which says that if tax is not withheld or after withheld it is not paid, then 30% of the expense shall be disallowed. Section 40A3 and 40A3A, it says that any cash payment in excess of 10,000 shall be disallowed. Apply in case of application of income of the trust. If the any application out of the corpus donation received is not treated as application. Okay. So if a donation was received with a specific direction, then you cannot apply it for general purposes. If you have applied, then we will not treat it as application. But If in subsequent year you have reinstated the corporate donation, you have make a new investment to the extent of this application from corporate donation, then the year in which you reinstate this corporate donation shall be, in such year, this reinstatement shall be treated as application. Okay. However, the amount not so treated as application. Which amount? The corporate donation which you have applied for general purpose shall be treated as application. We will treat this amount also an application in the previous year in which the amount is invested or deposited back into one or more of forms specified in section 11.5, maintained specifically for such corpus from the income of that year to the extent such investment or deposits. XYZ Charitable Trust is an education institution registered under section 12AB of the Income Tax Act. During financial year 25-26, the trust received a corpus donation of 25 lakh exempt with a specific direction that the corpus fund should be utilized for setting up a science laboratory. Okay. The trust intend to set up a lab only during PY 27-28 and will utilize the fund only during that financial year. Okay. In this regard, the trust want to understand whether the corporate donation exempt under section 11(1)(d) of the Income Tax Act. So yes, they are exempt. You have to keep them invested in the more specified in section 11.5. However, if you make any application out of this fund, such application shall not be allowed to exempt in section 11. But in such case, in the year in which you reinstate the investment, in such year, the reinstatement shall be treated as application. So it says voluntary contribution made with a specific direction shall form part of the is an exempted income. However, in order to avail exemption, such donation must be invested in the mode specified in section 11.5. Failure to deposit will result in incursion of income in the total income of the trust. Now, regarding loans and borrowings, it says if you have some loans and borrowings, then you applied such loan and borrowing, then you avail some loan from a bank, then you apply such amount in your charitable religious activity. Then the year in which you applied shall not be treated as application, but in the year in which you repay the loan, such repayment shall be treated as application. Okay. So application for charitable purpose from any loan shall not be treated as application. However, the amount not so treated as application shall be treated as application in the previous year in which the loan is repaid. Okay. So once you apply the loan, it's not treated as application because you have not applied from your own money. But when you repay the loan, then such repayment considered as application. But there's one more condition. The repayment should be within 5 years. Repayment made within 5 years from the end of the year in which such loan was applied for charitable religious purposes, in which such application was made from the loan or borrower. Okay. If there was a excess application in earlier year, then such excess application cannot be set off against the income of the current year. So no set of deduction allowable for any excess application of earlier previous year. In the case of trust, even the capital expenditure are allowed as such. So if you have purchased an asset for charitable purposes, then the cost of such asset shall be allowed as exemption in the year of purchase itself. But in such case, in subsequent years, depreciation of such assets shall not be allowed. There will not be double deduction. So it says no deduction of depreciation where cost of asset has been claimed as application. So assessee can either claim the cost of the asset as application, or you can claim the depreciation on such asset. But it cannot claim both. Both are mutually exclusive. You either claim the cost at once or you claim depreciation every year. Okay. See, illustration number 9. MSO Foundation, a registered charitable institution set up on 1st April 2024, is engaged in providing education in hotel management. Okay. So the charitable organization are engaged in providing education in the hotel management. The Organization acquires a building in July 2025 for using the same for holding classes and office activity. So the building was acquired for charitable purpose, holding classes. It approached you for your opinion on the eligibility to claim cost of the building and also depreciation thereon in the current year and the subsequent year. Advise the institution. So institution can either claim the cost or the depreciation. It cannot claim both. So in the July 2025, you claim the entire cost of the building as application, fine. But then in subsequent years, you shall not be allowed a depreciation. Would you advise change if building has been acquired out of loan taken July 2025 from a bank? In such case, the application, the purchase of building shall not be considered as application because it is applied from the loan proceeds. However, the repayment of loan shall be treated as application. Such loan is to be repaid in installment over a period of 7 years. Oh, but the repayment is allowed only for 5 years. So the SSC has incurred expenditure in July 2025. Then we have to end that year. The year ended on 31st March 26 and 5 years from this date. So 31st March 31. Up to this date, the any repayment shall be treated as application. Here it says, if building has been acquired out of loan taken from a bank, then cost of building cannot be claimed as application. Repayment of loan would be treated as application in the year of repayment. To the extent amount repaid for a period of 5 years from the end of the previous year in which building was acquired. The repayment up to 31st March 2031 will be eligible to be treated as application of the respective year of payment. Repayment made thereafter cannot be treated as application. Okay. Now, expenditure, deduction of expenditure is allowed only on actual payment basis. It's not allowed on actual basis. So you will be allowed exemption only in respect of those expenditures you are actually paid during the previous year. So VRS Foundation, a charitable institution registered under Section 12AB, set up on 1st August 2023, is engaged in providing education, sports management. Okay. It's a charitable organization. The foundation follows accrual basis of accounting and during the previous year 25-26 has accrued staff salary expense pertaining to the month of March 26 amounted to 5 lakhs. So for the month of March 26, it has accrued an expense of 5 lakh towards salary of the employee. The salary was paid during first week of the April. Fine. KS, the tax advisor of the foundation, has advised them that the salary expense provided for in the accounts will not be treated as application of income for the previous year. Examine. Perfectly, yes. True. Because the application is treated only in respect of expenditure which has actually been paid in the previous year. The expenditure has not been paid and therefore shall not be treated as application for PY 25-26, but it shall be treated as application for PY 26-27 in the year in which it is actually being paid. Okay, we discuss about the income under PGBP of the trust. Now, if the trust has any capital gain, it has transferred some capital asset which was held for charitable religious purpose and it earned a capital gain. So what the law says, if then you invested the net proceeds of a purchase of another asset to be held, then there will be no capital gain. But if you could not invest the entire net proceeds and you could only invest a part of such proceeds, then whatever you invested, any such amount in excess of the cost of the asset sold, the excess amount shall be treated as applied for the charitable purposes and the balance shall be taxable. So let's understand this with the help of example. The cost of original asset was 1 lakh. It has been transferred for 1,50,000. So there is a capital gain of 50,000. Now in situation 1, the SSC purchased a new asset for 1,50,000. So it has applied all the consideration. So entire capital gain shall not be taxable. But if it has applied only 1,20,000, then whatever has been applied minus the cost of the original asset, 1 lakh, the application shall only be treated as 20,000 and balance 30,000 shall be taxable. Amount that will be deemed to have been applied for charitable purpose shall be 50,000 situation 1 and 20,000 situation 2. Okay. If we discuss about the accumulation of income in two cases where the income is not received, or secondly, income is received towards end of the previous year. Okay. There may be a third situation where the trust can could not apply 85% of his income. In such case, it can go to the assessing officer and submit a form saying that I could not apply 85% of my income. I want to accumulate the income which I have not applied, and it has to provide the objects, provide the activities for which it has accumulated this income, for which it will utilize this income, and it has to provide the years in which such income has to be utilized. Such years cannot exceed more than 5 years. And such application has to be made at least 2 months before the and due to the furnished return of income. If any such application is made, it shall be deemed that of accumulation is not available if you have not furnished return of income within the due date. Consequence of failure to satisfy the condition, meaning you have said that you will apply this income for this purpose and you have applied for some other purpose, or you have said that you will apply this income within 4 years, you have not applied at all, or you have used it for any other purpose. So if the accumulated part is used for purpose other than charitable or religious, it shall be deemed to be the income of the previous year in which it is so applied. If it is ceases to be accumulated set apart, then such income shall be deemed to be the income in the previous year in which it is so seized or set apart. If it ceases to remain invested in the mode prescribed, then shall be deemed to be the income of the previous year in which it so ceases to be invested. It is not utilized for the purpose for which it is accumulated, then it shall be deemed to be the income of previous year during the last previous year of the period for which income is so accumulated, or it is given as a donation to any other trust. I told you the donation is allowed only from the current year income, it is not allowed from the accumulated income. If it is given as a donation from the accumulated income, then it shall be deemed to be the income of the previous year in which it is so paid or credited. However, law gives an option to the trust or society that if for reason beyond its control, it cannot apply this income for the object specified in the application earlier, it can approach the tax officer, assessing officer, and request for change of the object, and assessing officer, if satisfied, would allow the trust to make the investment in the different objects, provided the new object is also in conformity of the main object of the trust. So it says, a charitable institution registered under Section 12AB of Income Tax Act filed for number 10 for seeking permission to accumulate unapplied income under Section 11(2) of the Act. For the object of the institution submitted to AO along with the resolution for accumulation. The AO found that objects for which accumulation was sought were not particularized in as much as they covered the entire range of object of the institution. Can the AO deny the benefit of accumulation such as what are the facts? It says that the trustee wants to make an accumulation. It could not apply 85% of income during the current previous year. It's applying for the accumulation of the income which it could not apply. But in the form number 10, where it applies for this accumulation, the purpose of accumulation is stated to be the object of the trust. So very general, not any particular object. On this ground, the assessing officer is of the view that application of accumulation should be rejected. But the Supreme Court in the case, the Delhi High Court in the case of Bharat Krishak Samaj has held that it is not mandatory for the assessee to particularize each and every object for which this income is to be applied. If the purpose is as per the object of the trust, then it has sufficient compliance of section 11(2). Held that it is not necessary for charitable trust to particularize each and every object for which accumulation is sought. It is enough if the assessee seeks permission for accumulation of the object of the trust. Therefore, AO cannot deny the benefit of accumulation. A charitable institution registered in section 12AB of the Income Tax Act for previous year 31st March 2026 filed form 10 for seeking permission to accumulate unapplied income for a period of 5 years under section 11(2) for the object of the institution and submitted to the AO along with resolution. The charitable institution could not utilize the accumulated income within a period of 5 years. Examine the consequence. So it shall be taxable. So it shall be taxable in the previous year, being the last previous year of the period for which income accumulated is not utilized. Unsaid income will be taxable in the 5th year as it is the last previous year. Okay. See, at the time of registration, we touch upon the fact that there may be a situation where the registration becomes inoperative. Now, this is the situation. So, the law says section entities claiming exemption under section 11 and 12 cannot claim exemption under section 10. So, they are mutually exclusive. So, what the law says, if the registration granted for availing exemption under section 11, 12 will become inoperative. So you already have an exemption in section 11, 12. You already registered in section 11 and 12. Then such registration shall become inoperative. Shall not be cancelled, but shall become inoperative from the date on which trust or institution is approved under section 1023C or another clause of section 10. Or from first April previous year for the exemption is clear. Okay. But in this case, trust can apply for making the registration operative. The trust whose registration has become inoperative may apply to get the registration operative, subject to the condition that on doing so, once the registration becomes operative, the approval under section 10 to such trust shall the moment that the registration section 1112 becomes operative, then the such trust shall not be entitled to claim exemption under section 10 from such state. So they both are mutually exclusive. So what the law says, the trust was already registered under section 11 and 12. Now it has applied for registration under section 1023C. Now in such case, the registration under section 1112 shall become inoperative. However, the trust can make it operative, but once it makes it operative, then this exemption shall not be available to the trust. So either section 11 or section 10 exemption, except section 10(1). There is one small topic, denial of exemption. So earlier we discussed the 3 situations where the registration could be cancelled. Now we will discuss the situation where there is valid registration has not been cancelled or withdrawn, but for such year the trust is not eligible for the exemption. Okay. So one of the circumstances where trust is not eligible for the exemption if the income from property held in trust is applied for private religious purposes or for any particular religious community or caste, or if the income of the trust is applied for any benefit of specified person. We discuss trustee, author, founder, etc. Then such part of the income is taxable under Section 105 BBI at the rate of 30%. And also, trust is liable for penalty in Section 271 AAE. If funds of the trust are not deposited in the mode specified, okay. Now, when we call that a benefit is given to a specified person. So, if any loan is given without adequate interest or security to that person, then a benefit is given to him. If such person is allowed to use the property of the trust without the adequate rent, if the trust has availed some service from such person but has made excessive payment more than the arm's length price, if the trust has given some service and has received inadequate consideration, or it has made excess payment for purchase of the property, but if in case the trust has sold the property, it has received inadequate consideration, or the diversion of income property of trust to such person, or if the trust has invested in a concern in which such person has substantial interest. In these cases, it shall be deemed that a benefit is given to the specified person. Now, who are specified person? The author of the trust or the founder of the institution, okay, the founding member. Any person, this is important, whose total contribution to a trust during the previous year exceeds 1 lakh, or in aggregate up to the end of the previous year exceed 10 lakh rupees as the case may be. So, substantial contributor. Where the author or the founder is a HUF, any member of the family, any trustee of the trust or manager of the institution as the case may be, any relative of such author, founder, member, trustee, or manager as the case may be, or any concern in which any of these people has substantial interest. All these people are come under the category of specified person. If you give any benefit to the specified person, benefit can be your advance loan for inadequate interest or security. You have given any service and charge inadequate. You have availed service and give more than the market price. You have sold the property for inadequate consideration or purchased the property for more than the consideration. You have diverted your income, or you have applied in a concern which such person has substantial interest. Then such benefits shall be taxable in your hand under Section 105 BBI at their 30%, and shall also be liable for penalty in Section 271 AAE. However, if the benefit is in the nature of education or medical, the exemption is not withdrawn. The value of such benefit taxable in the hands of the trust. The exemption is not available for anonymous donation. Now, what are anonymous donation? Where the identity of donor is not known. So if there is an anonymous donation received by the trust, then such anonymous donation is not eligible for exemption. They shall be taxed at the rate of 30%. But taxable amount is in excess of a limit, which we'll discuss in a minute. See, it says if the trust was registered as under the residual clause of advancement of general public utility, and if the trading receipt exceed 20% of the total receipt, then the exemption shall be withdrawn for such year. And if not, that registration shall be withdrawn. Also, the exemption shall not be available if the trust shall not furnish return of income within a due date or has not furnished the tax audit. Now we'll discuss anonymous donation after a break. So we'll discuss about the anonymous donation, what is anonymous donation and its tax impact. Yeah. So we'll break. We have a break of 5 minutes. It's 7:34. We meet on 7:40. I told you, anonymous donation is a donation where the identity of the donor is not maintained by the trust, is not known to the trust. So who has given the anonymous donation is not known. In such case, the anonymous donation taxable at 30%. However, donation which is taxable is exceeding the share of this limit, which is 5% of total donation or rupees 1 lakh. Whichever is higher amount is the limit. In addition to such limit, whatever anonymous donation is received, such addition shall be taxable, such excess amount shall be taxable at the rate of 30% in the section 115BBC. Okay. So what is the limit? 5% of the donation received or 1 lakh, whichever is higher. See, there is a small example to make you understand this concept. In situation A, the total donation received was 15 lakh. Anonymous donation was 4 lakh. Comes to 75,000 and 1 lakh, whichever is higher. So 1 lakh. So anonymous donation excess of 1 lakh means the 3 lakh shall be taxable at 30%. In situation B, the total donation is 30 lakh. The 5% of 30 lakhs is 1 lakh 50, of 1 lakh, whichever is higher, means 1 lakh 50. The anonymous donation received is 7 lakh. So the excess amount, 5 lakh 50,000, shall be taxable at 30%. And the rest amount shall be treated as normal donation. Total donation 40 lakh. The 5% of 40 lakh is 2 lakh or 1 lakh, whichever is higher. So 2 lakh. The anonymous donation was 10 lakh. So 8 lakh shall be taxable at 30%. Now it's clear to you? Anonymous donation means any voluntary contribution where the person receiving contribution does not maintain a record of identity indicating the name and address of the person making such contribution and such other particulars as may be prescribed. However, anonymous donation, the taxability of anonymous donation is not applicable to religious organization. So if an organization is working wholly for religious purposes, then there is no more in if you think in case of religious organization, most of the contribution is anonymous because people give in the Dan path. Okay. So this provision, this anonymous donation is not applicable in religious organization. If an organization is partly religious and partly charitable, then the anonymous donation received for religious purposes shall not be subject to section 115BBC. This section is applicable only in respect of anonymous donation received for charitable purpose. Okay. Further, anonymous donation to a trust created wholly for religious and charitable purpose would be taxed only if such anonymous donation is made with a specific direction that such donation is for any university or education institution or hospital or medical institution run by such trust. Other anonymous donations received by such trust are not taxable. Yeah. So it says the following trust claim that anonymous donation received by them during the financial year 25-26 are not liable to tax under section 105BBC. A charitable trust referred to in section 11 which applied the entire amount of anonymous donation for the purpose of the trust. So the fact that entire amount of anonymous donation is applied for its object is not relevant. If you are a charitable organization, then section 115BBC is applicable on you and the anonymous donation in excess of the prescribed limit shall be taxable at 30%. A trust established wholly for religious purposes, which applied 85% of the amount of anonymous donation for received by a trust working wholly for religious purposes, then section 115BBC is not applicable to such trust. It says amount of income tax with which SSC have been chargeable total income. Here, taxability of anonymous donation are not applicable to any trust created wholly for religious purposes. Now there's section 105 BBI, which applies on some specified income and says that such specified income shall be taxable at 30% on gross basis without allowing any deduction or loss or depreciation as the case may be. Such specified income means income accumulated set apart in excess of 15% of income, which such accumulation is not allowed under any specific provision. If you have could not apply to 5% of your income and has also not applied the accumulation, then the difference is taxable at under section 115 BBI. Deemed income on account of violation of certain conditions stipulated in accumulation under section 11.3 and corresponding provision in section 1023C. So if you have accumulated for a period of 5 years and you have violated the condition of accumulation, then such income shall be taxable under section 105BI at 30%. Deem income on account of violation of deem application provisions specified in section 11.1b. So if you applied the income because it was not received or received later in the last part of the previous year, and you have not complied with the condition of accumulation, then such income shall be taxable at 30%. Any income which is not exempt under section 1023C on account of violation of third clause of 23, that is invested in impermissible mode. Any income which is applied for the benefit of specified person, or if your income is applied outside India but you have not obtained the approval of CBDT. So this was all about charitable institution. Now we'll discuss about accredited tax, accredited income and accredited tax. What is it? It says a trust works for many years, and in all these years it takes the benefit of income tax at majorly co 15%. Okay, so it enjoys the income tax benefit on the income received by it, but at the time of its dissolution, whatever income it has accumulated, should have been used for object of the trust. But what it did that it dissolved and it distributed an asset for object other than charitable religious purposes. Then in such case, it should be taxable. So when at the time the trust is converted into non-charitable, in such time the provision of accredited tax comes into play, and whatever the fair market value of the net asset is there as on such date, such asset shall be, such amount shall be, such fair value shall be taxable as, and tax is paid as accredited tax. So this was the background. Okay. It applies, this accredited tax applied on specified person. Specified person means any fund or institution or trust or university or education institution or hospital or medical institution referred to in section 1023C or trust or institution under section 12AA or 12AB. So these two institutions have availed the benefit under that. So they are subject to accredited tax. The accredited income of specified person shall be taxable at MMR, which is 34.944%. On conversion into a form non-eligible for grant of registration, when the trust has converted itself into such form that it cannot be granted registration under section 1023C or 12AB, that on such date it shall be liable for accredited tax at the MMR. Or it has merged with any entity which is not liable, which is not eligible for the registration, or it has distributed asset for purpose other than charitable religious purpose on its dissolution. In these three events, the trust is liable to pay accredited tax. Now, what do you mean by conversion to non-eligible form? It can be the fact that your registration has been withdrawn or cancelled, or you have modified your object, but you have not applied for the registration, or the registration applied has not been accepted. Or you have not renewed your registration. Okay. What is the accredited income? Very simple. Aggregate fair market value of total asset, add is reduced by the total liability. While computing, but accredited income shall not include the asset which you have purchased from the agricultural income exempt under section 10(1). You should also not include the asset which was purchased when the trust was not registered. Or during the period when trust has not availed the benefit, the asset purchased during such period shall not be liable to tax. Logical enough? Okay. Accredited income should also not include the asset which has actually been distributed to another trust on dissolution, which has a common same object. This exit tax is payable even if no income tax is payable by the specified person. Now, what is the date of conversion? Whether registration of section 12AA has been cancelled, the date shall be date on which the registration has been cancelled. Where the object has been modified, the date shall be date of modification. Where the trust has failed to make an application for renewal of registration, the last date of making the application for registration. So this date is important because I will take the fair market value of the asset and liability as on this date. Such tax has to be paid within 14 months from where the registration has been cancelled. It's 14 days. The such tax has to be paid within 14 days in a case where the registration has been cancelled. The 14 days from the date when this cancellation has become final. Okay. But what the law says, the date on which period for filing appeal has expired and no appeal has been filed, or the order in any appeal confirming the cancellation of registration is received by the specified person. So whenever this cancellation has become final, 14 days from such date, you have to pay the tax. If you have modified the object and have not got them approved, not got them registered, then the liability to pay the exit tax arises 14 days from the end of the previous year. Where it has applied for the re-registration case of modification of the object, but the application was rejected and the tax has to pay within 14 days from the date when this rejection becomes final, as we discussed above. If the trust has merged with any other entity which is not eligible for registration, then tax has to be paid within 14 days from the date of such merger. If trust fail to transfer the asset on its resolution to any other similar charitable religious trust, then the exit tax has to be paid within 14 days from the date on which period of 12 months expires. If the tax is not paid within this time, then simple interest at the rate of 1% per month or part of the month shall be applicable. And if this tax remains due, the trust, along with the trustee or the principal officer, shall be liable for the payment of such tax. And also, the new trust, the different trust who have received the asset on dissolution of first trust. So this trust, the recipient trust, shall also be liable for the payment of exit tax, but its liability shall be restricted to the asset received by it. Now, how you compute the accredited income? So we told accredited income means fair market value of the asset minus liabilities. But you will not add. The asset shall not include any amount of income tax paid as deduction or collection or any advance tax paid as reduced by the amount of income tax claim as refund, and amount shown an asset include the unamortized amount of deferred expenditure. Okay. So these two assets, though appearing on the asset side of the balance sheet, are not considered as asset for the purpose of accredited income. Now, how you compute the fair market value of different assets? If the asset is quoted share or securities, then the fair market value shall be the average of the date, then the price shall be the average of the highest and lowest price on any date preceding such date where there was a trading. Okay. But in case of unquoted equity shares, the value shall be derived basis the formula A plus B minus L into PV beta PE. A means the book value of the asset. B means the B means the fair market value of some of the asset. L means the liabilities. So book value, first you will add book value of all assets except bullion, jewelry, precious stones, artistic work, shares, security, and more property. Because for these assets, you will take the fair market value, which is B. Now, B is the fair market value of these assets: bullion, jewelry, precious stones, artistic work, quoted shares, or more property. Shares and security and more property. Then L is the liability book value of the liability. But in liability, you will not include any contingent liability or any amount set up of payment of dividend, any reserve and surplus by whatever name called. Those reserve and surplus are not liability. Any amount representing provision of income tax, any amount representing provision made for meeting liabilities other than a certain liability. So these are actually the reserves. Any amount of cumulative preference share. Preference shares are not liability. So you will not consider all this amount as a liability. So what is the value? A, book value of asset except the fair market value of some asset, which is B minus L. Now we discuss about the B. Share and securities other than equity share. The fair market of these shares and securities shall be the value it will fetch in the open market. Price it will fetch if sold in the open market. Immovable property. The value shall be higher of the value it will fetch if sold in the open market or its stamp duty value as on the specified date, whichever is higher. Business undertaking, the same formula A plus B minus L. Any other asset, the value shall be the value it will fetch if sold in the open market as on the specified date. Okay. So this was about accredited income and tax. Now we are moving to other types of trust. We first do the taxability of political parties. So they are political parties. The amounts were received by them for the tax implication in the hands of political parties. So taxation of political parties is governed by section 13A, which says all income of political party except the income under PGBP shall be exempt. So income under house property, income under capital gain, income under other sources of political party are completely exempt. Okay. And of course, political party is not engaged into any business profession, and therefore there is no income under such head. And the remaining head is salary head, which is not applicable in case of political party. So section 13A grants exemption from tax to political party in respect of their income specified below, which is income from house property, other source, capital gain, or voluntary contribution received. So all types of income, whatever it can have, is exempt in the hands of political party. So how much benefit? However, to claim an exemption, the political party has to satisfy these conditions. It has to maintain books of account and other document to enable the AO to properly deduce its income therefrom. It should maintain a record of each voluntary contribution in excess of 20,000 and should have the name and address of the person making such contribution. The accounts of the party should be audited by the chartered accountant. No donation exceeding rupees 2,000 should be received otherwise than through banking channel. The political party should be registered under the Representative of People's Act 1951 and it should furnish return of income for the financial year. So to claim exemption, all these things has to be satisfied. So it should maintain books of account, it should maintain the identity of the person making contribution of 20,000 or more. The contribution more than 2,000 shall not be received outside the banking channel. The books of account should be audited. The political party should be registered under the Representative People Act. And lastly, it should furnish return of income. Okay. So let's see the question. It says, explain in the context of the provisions of the Act whether income derived during the year and the 31st March 2026 in following case shall be subject to tax or not. A political party duly registered under Section 29A of the Representative People Act received rent of 1,25,000 per month of one of its building let out to a bank from 1st June 2025. So this rental income from a building let out to a bank is an income under that house property, and Section 13A exempt income of political party under the head house property. So this income is not taxable. This income will not be included in the total income. The books of account maintained by National Political Party registered with the Election Commission for the year ended 31st March 2026 disclose the following receipts. We have to compute the total income political party for assessment 26-27 with reason. Okay. So rent of property let out to a departmental store exempt under Section 13A. Interest on deposit exempt under Section 13A. Income from other sources. Contribution of 21,000 each from 100% who have secreted their names. Secreted their name means the political party does not have the name and address of the person making the contribution, and the amount of contribution exceed 20,000. So this contribution shall not be eligible for the exemption. Contribution from 10% by way of electoral bond. So this, the condition of maintaining the identity of person does not apply in case of electoral bond. This shall be exempt. Cash contribution at the rate of 2,100 each from 1,000 members. So you cannot receive cash contribution in amount exceeding 2,000. So this is a default. Net profit of cafeteria run in the premises of Delhi 3 lakhs. Okay. So completion of total income, since the political party has defaulted and therefore it shall not be eligible for the exemption under Section 13A. So this rent shall be taxable after allowing the 30% standard deduction. Then this interest, voluntary contribution shall be taxable, and net profit from cafeteria shall also be taxable. Alternatively, what the question says, the political party can contend that only 45 lakh, which is this contribution and CGBP income is taxable on account of non-maintenance of records and receipt of cash donation, in which case the total income will be computed as untaxed. Clear? So either you do, if there's any default, you withdraw the exemption, tax everything, or you only tax such income where there's a default. So there's alternative answer. Now we're talking about electoral trust. So what happens is that there's a political party, then there's electoral trust, which issue electoral bond, and people can subscribe to electoral bond, and such electoral trust give 90%, 95% of their receipts to a political party. So a political party always have an electoral trust associated with it, and whatever electoral bond is sold, the amount so received, 95% of such amount is donated to the political party. Income of electoral trust is always exempt. But similar to political party, it has to maintain books of account, get them audited, maintain record of proceeding of all meetings, should have a certified copy of contributor and a list of political party to whom some were distributed in the manner prescribed. And such statements to be submitted to the commissioner or director of the income tax every year along with audit report. So electoral trust, who are signing the electoral bond, must maintain a record of the people who have purchased the bond and the political party to whom it has donated the receipts. And such statement has to be furnished with CIT or DIT as the case may be, along with the audit report. Okay. So this was all about the political party and electoral trust. Now we are left with only three small topics: securitization trust, investment fund, and business trust. Okay. These trusts have a common concept of pass-through entity. Do you know the meaning of pass-through entity? What do you mean by pass-through entity? Pass-through entity means that if any income is received by it and it distributed the amount received to its unit holder, then such income which is not taxable in the hands of trust. So what happens is that there is a trust, there is some person say SPV or something, which is giving income to a trust. And side by side, the trust is giving income to its members. Right? Now the law says, in respect of some income, this trust shall be considered as pass-through entity. Meaning, though income is passing through this trust, but this income shall not be subject to tax in the hands of a trust, it shall be taxable in the hands of member. Okay. Since income is not taxable, there will not be deduction of tax, there will not be any TDS by the payer. So if income is not taxable in the hands of trust, this payer shall not deduct tax of the trust. And if income is any amount distributed by trust to its member, if such amount is not taxable in the hands of member, then trust shall not deduct TDS. So understand the basic thread between this securitization trust, investment fund, and business trust. So, firstly, let's start with the securitization trust. The securitization trust is considered as pass-through entity. The income of securitization trust from the activity of securitization shall be exempt. Now, if the income of securitization trust is exempt, then such income shall be taxable in the hands of its member. So, any income accruing or received by a person being an investor from the securitization trust out of investment made by it in the securitization trust shall be taxable in the hands of the investor. So securitization trust becomes a pass-through entity. The income so received by it is not taxable in cent, but this amount is distributed to the investor and this amount is taxable in the hands of the investor. As if investor had made direct investment in the underlying asset and not through the trust. What is happening is this member is investing this asset through the trust. But law says that I will ignore this first and I will treat as if the investment is made directly by the member to the trust, to the SPV. And any amount received by SPV through the trust shall be taxable in the hand of member, shall not be taxable in the hand of trust. The trust has given a status of pass-through entity. Understood? What is the nature of the income in the hands of the investor? So the law says when you have considered the trust as pass-through entity, to whatever nature the trust has received the amount, the nature shall remain same in the hands of the investor also. The trust has received dividend from the SPV, so the amounts are distributed by the trust to its investor. The nature shall remain same as capital gain in the hands of investor as well. If the trust has received this amount as capital gain, the nature shall be capital gain. If trust has received this amount as interest, the nature shall be same as interest. Even the proportion of income shall be the same. So the income paid or credited by the securitization trust shall be deemed to be the income of the same nature and same proportion in the hands of the investor securitization trust as if it had received by or had accrued to or arisen to the securitization trust during the previous year. So it is said that the trust securitization trust had received dividend of say rupees 10 lakh, interest of say rupees 20 lakh. Right now, it has distributed the amount to its investor, and one of the investor receives say rupees 6,000. Okay, so there will be many investors. All investor will receive a surplus in the ratio of their units held. So one investor, say Mr. A, has received rupees 6,000. Now the 6,000 shall be taxable in the hands of Mr. A, but it shall be taxable as interest and dividend in the ratio of 1:2. So dividend is 1 by 3 means 2,000, and interest is 2 by 3 means 4,000. In the same ratio, 1:2. Okay, and the same proportion and the same nature. Now it says that if the trust has not distributed its income, we shall deem that distribution shall happen and tax and will tax the investor. The income accruing or arising to or received by securitization trust during a previous year has not been paid or paid to the investor. So though income has been received by the securitization trust, but it has not been distributed to the investor, the same shall be deemed to have been carried to the account of said person on the last day of the previous year in the same proportion in which such person would have been entitled to receive the income had it been paid in the previous year. So the law would deem that it has been carried to the account of the investor and in the same proportion, the same nature, had it been distributed. Okay. So if the amount has not yet been distributed, but it has been deemed as distributed and therefore has been taxable in the hand of investor, when a subsequent year, when it shall be actually distributed, it shall not again be taxable. Logical? Now, in this example, how would Mr. A would be able to know that out of 6,000, dividends 2,000, interest is 4,000? So for this, the law says the securitization trust shall provide breakup regarding nature and proportion of its income and such other relevant details to the investor and also to the prescribed income tax authority in the prescribed form and verified in prescribed manner within the prescribed time. So when the investor will receive 6,000, he will also receive a statement providing the breakup of income of securitization trust as per the nature, different nature, and the same proportion he can apportion the amount so received by it. Where the income has been included in the total income of investor in a previous year, on account of having accrued or arisen in the said previous year, the same shall not again be included in the total income of such person in the previous year in which such income has actually paid. So if the securitization trust has not distributed the income, then law deemed that distribution shall happen on the last day of the previous year. But in such case, in the subsequent year, when the actual distribution shall happen, in such year, the amounts so received shall not again be taxed in the hands of the investor. Illogical? Not tedious. So, securitization trust is required to withhold TDS on the payment made to the investor because such amount is taxable in the hands of investor. So, if the investor is resident, the tax is withheld at the rate of 10%. If the investor is non-resident, then tax is withheld at the rates in force. Whatever the rates, such income is taxable in the hands of NR. At such rate, the tax shall be withheld. So in case of NR, always the tax is deducted at the rate which is applicable on the NR, on such income. The investor may apply for the lower or nil withholding certificate in respect of income to be received from securitization trust. In such case, when a certificate is issued, the securitization trust shall not withhold the tax or shall withhold the tax at such lower date. So this was all about securitization trust. So you will see that the securitization trust is a pass-through entity in respect of all its income. Whatever income it is received is taxable in the hands of investor. The income which is received by the investor shall be taxable as per same nature and same proportion. Okay. Now we will do a similar concept, investment fund. So investment fund are also treated as similar to securitization trust, a pass-through entity. Just a one difference. In case of securitization trust, all income of securitization trust are taxable in the hands of its investor. However, in case of investment fund, the income under PGBP is taxable in the hands of investment fund, and any other income except the income under PGBP shall be taxable in the hands of investor. So, investment fund shall act as a pass-through entity in respect of all income except the income under PGBP, which is taxable in the hands of investment fund. See, as we discussed about, there is only taxation at once. If the income is not taxable in the hands of trust, then income is taxable in the hands of investor. But if income is taxable in the hands of trust, then such income shall not be taxable in the hands of investor. So there is a pair of income. This is investment fund. And this is investor. Okay. Okay. Now, if investment fund receives interest, etc., interest dividend, then such interest dividend is not taxable in the hands of investment fund, and therefore payer shall not withhold TDS. However, since this income is not taxable in the hands of investment fund, which shall be taxable in the hands of investor, and since this income is taxable in the hands of investor, the investment fund shall deduct TDS. Clear? Why TDS? Because this income is taxable in the hands of recipient. Now, if investment fund is receiving PGBP, then such PGBP taxable in the hands of investment fund, the payer shall do TDS. Now, this PGBP amount is distributed to the investor. It will not be taxable in the hands of investment fund, and therefore investment fund is not required to do TDS on this payment. So clear? First, the income shall be taxable either in the hands of fund or the investor. Wherever the income is taxable, the payer of such income shall withhold tax. If income is not taxable, the payer shall not withhold tax. Okay. In securitization trust, we saw that all income is taxable in the hands of investor, and therefore the payer of income to securitization trust shall not withhold tax, but securitization trust shall withhold tax on payment to the investor. Tax shall be held at the rate of 10% if the investor is resident, as the rates in force the investor is non-resident. Let's see in case of investment fund. Look at any income accruing or rising or received by a person being a unit holder of investment fund out of investment made in the investment fund shall be chargeable to tax in the same manner as if income is accruing or rising or received by the investment fund, had the investment made by the investment fund being made directly by him. Similar provision to securitization trust. In securitization trust, also we assume that the income so received by the investor is from the investment as if the investment is made directly by the investor and not through the trust. Similarly, in the investment fund, the income so received by the unit holder shall be from the investment made by the unit holder, assuming the investment is made directly to the SPV and not through the investment fund. The scheme provides for exemption of income other than income chargeable under PGBP in the hands of investment fund. So in the hands of investment fund, all income exempt. By this, we understand that such income shall be taxable in the hands of unit holder. But PGBP, income under PGBP taxable in the hands of investment fund, then such income shall be exempt in the hands of unit holder. The income in the nature of PGBP shall be taxable in the hands of investment fund. Clear? In case of securitization, every income was taxable in the hands of investor. But in case of investment fund, the PGBP is taxable in the hands of investment fund, and all other income is taxable in the hands of investor, unit holder. Income accruing or arising to or received by unit holder of investment fund, being that proportion of income which is of the same nature as income chargeable under PGBP at investment fund level, shall be exempt under the head under section 1023 FBB. So it says the income in the nature of PGBP which is distributed by the investment fund to its unit holder shall be exempt in the hands of unit holder. Logical enough, because this income is taxable in the hands of investment fund. This implies that all income from investment fund is taxable in the hands of unit holder except income under PGBP. This is because all income except income under PGBP exempt in the hands of investment fund, and therefore, consequently, such income shall be taxable in the hands of unit holder. But the income under PGBP is taxable in the hands of investment fund, and therefore such income shall be exempt in the hands of unit holder. TDS. Investment fund has to get TDS on any income except income under PGBP. Why? Because income under PGBP is not liable to tax in the hands of unit holder. The rate of it is 10% if the recipient is resident, or rates info in case of non-resident. The same as there was in securitization trust. Similar provision. If in any year there is not a similar provision. Now this is important. Where it says that if there is a loss to the investment fund, then if the loss is under that PGBP, it shall be carried forward by the investment fund itself. But if it is a loss under any other head, then the benefit of such loss shall be allowed to the unit holder. Why? Because had it been an income, then such income shall be taxable in the hands of unit holder. Then in case of loss, the benefit should also be allowed to the unit holder only. But such benefit is allowed only if the unit holder holds the unit for at least 12 months. So if the units are held for more than 12 months, then only the benefit of loss, which has actually been incurred by the investment fund, shall be available to the unit holder. Okay. The income paid or credited by the investment fund shall be deemed to be the same nature and the same proportion in the hands of unit holder as if it had been received by or accrued or arisen to the investment fund during the previous year. Similar provision, the nature and the proportion of income in the hands of unit holder shall remain same as it is in the hands of securitization trust or investment fund. Tax on income of the investment fund. So the investment fund is formed as a form of company or firm, then they shall be taxable at the rate applicable to it as per the Finance Act. If it is formed other than company or firm, then the investment fund is taxable at MMR. And what is the income on which investment fund is required to pay tax? It is income under head PGBP. Clear? As similar to securitization trust, here also if income accruing or received by investment fund during the previous year is not paid to the unit holder, it shall be deemed to have been credited to the account of unit holder on the last day of the previous year in the same proportion in which such person would have been entitled to receive the income had it been paid in the previous year. Income tax in the year of accrual shall not again be taxed in the year of payment. Okay. So this table summarizes the provisions. Income under PGBP taxable in the hands of investment fund, exempt in the hands of unit holder. Income other than income under PGBP taxable in the hands of unit holder, exempt in the hands of investment fund. Now, this income investment fund is required to withhold tax. If the unit holder is resident, then tax rate is 10%. In case of NR, tax should be directly at rates in force. Losses under PGBP shall be carried forward by the investment fund and not passed to the investor. Any other losses? Where such loss has arisen in respect of unit which has not been held by the unit holder for a period of at least 12 months. So the act is silent. If the loss is in respect of unit which has not been held for more than for 12 months or more, then such loss can be carried forward by unit holder or investment fund. The law is silent. The law says such loss cannot be allowed to the unit holder. Whether it can be allowed to the investment fund or not, the law is silent relating to the permissibility. So losses other than the loss under PGBP and other than the loss in respect of units held for less than 12 months. Means losses in respect of unit held for more than 12 months shall be allowed in the hands of unit holder, not allowed in the hands of investment fund. The unit holder can carry forward and settle such loss against the income. Okay. Similar to securitization trust, the investment fund is also required to furnish a statement to the unit holder and the prescribed authority specifying the nature and proportion of the income so received by it. Every investment fund has to compulsorily furnish return of income. Okay. Now see a simple example. The following are the particulars of income of 4 investment funds for previous year 25-26. Business income, capital gain, income from other sources. Compute total income of investment fund and each unit holder for AY 26-27, assuming that each investment fund has 20 unit holders, each having 1 unit held for them for a period exceeding 24 months. And income from investment in the investment fund is the only income of the unit holder. Okay. So there are 20 unit holder, equal unit holder. The investment fund is A. It doesn't have business income, the capital gain, and other source. Both shall be taxable in the hands of unit holder only, and there shall be no income in the hands of investment fund. And the income in the hands of unit holder shall be in the proportion of capital gain and other sources. So there is an income of 16 lakh of capital gain. In the hands of one unit holder, it shall be taxable at 16 lakh divided by 20. So it comes as 80,000. And similarly, other source income shall be 4 lakh divided by 20 means 80,000. So in case of A, in the hands of investment fund, nil income, but in the hands of unit holder, 80,000 and 20,000, 1 lakh. So what I did nothing. I just divide the income by the number of unit holders, 20. In case of B, this 2 lakh shall be taxable in the hands of investment fund, and this 14 and 4 lakh shall be taxable in the hands of unit holders in the proportion of their units held by them. The 2 lakh unit holder and 90,000 or 2 lakh investment fund, 90,000 unit holder in the proportion of the units held by them, which is 20. So 5%. No. Yes, 5%. Now see investment fund C. It is a loss under PGBP, then loss under capital gain and income from other sources. So loss under head capital gain cannot be set off against any other income. But loss under head PGBP can be set off against other sources. So the income would be nil, 6 and 6. Since there is no PGBP income, there would be no income in the hands of investment fund. This loss of 6 lakh and income of 6 lakh shall be taxable and allowed in the hands of unit holder. The unit holder shall be allowed shall have to pay tax on 30,000 income from other sources. Okay. So in case of investment C, the business loss of 2 lakh set off against income from other source, loss of 6 lakh under capital gain shall be carried forward by the unit holder for set off in subsequent year. Okay. Now lastly, investment fund number D. This PGBP is 5 lakh. There is a loss of 2 lakh other sources. So this other source loss shall be set off against PGBP, and 3 lakh shall be taxable in the hands of unit holder or investment fund, and 20 lakh, the proportionate share, means 1 lakh, shall be taxable in the hands of unit holder. Clear? If this question come in exam, you will be able to attempt it. Now question says, if investment fund C has the following income component for AY 27-28, what would be the total income of the fund and the unit holder for that year? So it says it's have given particular for the subsequent year. So there's a business income of 2 lakh, capital gain of 9 lakh, and other source of 8 lakh. So this 2 lakh shall be taxable in the hands of investment fund. Now this 9 lakh and 8 lakh. This 8 lakh shall be taxable in the hands of unit holder. Out of this 9 lakh, only the proportionate shall be taxable in the hands of unit holder, but the unit holder also has a brought forward loss under the head capital gain, or equivalent to his share in the 6 lakh. So only the remaining amount shall be taxable. So 3 lakh divided by 20 shall be taxable. For AY 27-28, brought forward capital loss of 30,000 can be set off against capital gain of 45,000 proportionate share by the unit holder since the period of holding is 24 months or more. Business income of 2 lakh will be taxable in the hands of investment fund. Income from other sources shall be 40,000 will be taxable in the hands of unit holder. So clear? So securitization trust, very simple. All income taxable in the hands of investor. Investment fund, similar to securitization trust, all income taxable in the hands of unit holder except PGP, which is taxable in the hands of investment fund. Second difference, in case of loss, under the PGBP, such loss shall be allowed to the investment fund. In case of loss under any other head, such loss shall be allowed to the unit holder, provided the unit holder holds the unit for more than 12 months. If the unit holder holds the unit for less than 12 months, then the loss in respect of such unit shall not be allowed in the hands of unit holder. Clear? Now, last topic for our class for today is business trust, and important from your exam point of view. So there are two types of business trust. One is REIT and other is InvIT. Do you know the full form of REIT and InvIT? I tell you. Real Estate Investment Trust and Infrastructure Investment Trust. So there are two types of business trust, REIT and InvIT. Okay. Now, similar to securitization trust and investment fund, we have to see for which income these business trusts are given a status of pass-through and for which income they are not considered as pass-through. Because the income for which they are considered as pass-through, such income shall be taxable in the hands of unit holder, and these trusts shall be liable to deduct tax on such income. Because this income is taxable in the hands of unit holder. However, the income in respect of which these trusts are not held as pass-through, such income shall be taxable in the hands of these trusts and shall be exempt in the hands of unit holder. Okay. On this much is the concept. Now, what is REIT? REIT invest in the real estate assets. What is InvIT? InvIT invest in the infrastructure asset. They derive income from such asset and distribute it to their unit holders. Okay. So section 115UA provides that any income distributed by business trust to unit holder shall be deemed to be of same nature and the same ratio proportion in the hands of unit holder as it had been received or accrued to the business trust. So similar provision as we discussed in case of securitization trust and investment fund. So the income is treated as in the same nature and same proportion as is received by the business trust. Okay. How there is one special income in this case, which is not taxable in the hands of business trust, but taxable in the hands of unit holder, but not having the same nature. This income is taxable under section 56 other sources. This is the income other than the income received by unit holder, other than the income in the form of interest and dividend, rental income in respect of property directly owned by REIT, or any other income chargeable tax in the hands of business trust. If except these three income, the unit holder received any other income from the business trust, such other income shall be taxable in its hands under section 56 to 12 under the head other sources. So what income remains is this such income shall be chargeable and would be include repayment of debt or amount paid against redemption of unit to the unit holder. So if the unit holder has given any debt, any repayment made, then such repayment shall be taxable under that other source under section 56 to 12. Or to the redemption of units of unit holder, then such redemption amount shall be taxable under that other source under section 56 to 10. Okay. And these two income, the interest dividend and the rental income in respect of property directly owned by the REIT, these income are taxable in the hands of unit holder, and meaning thereby for these income, the business trust act as a pass-through entity. And for the other income, such income is taxable in the hands of business trust only and exempt in the hands of unit holder. Except these three income, if there is a repayment of debt or redemption of units of unit holder, such amount, income component from such amount shall be taxable in the hands of unit holder in section 56 to 12. Section 1023 FC says that falling income of business trust, meaning these incomes shall be taxable in the hands of unit holder, meaning in respect of these income, the business trust has been given a status of pass-through, which is interest or dividend received or receivable from a SPV. I told you. Does business trust enjoys a pass-through status in respect of interest or dividend received or receivable from SPV? And any income business trust being REIT by way of renting or leasing or letting of real estate owned directly by such business trust. So if the REIT directly own the real estate asset, then the rental income from such asset is exempt in the hands of REIT. So these assets are directly owned by REIT and not owned by SPV. However, if the assets are owned directly by SPV and not REIT, then such income is taxable in the hands of REIT and not in the hands of unit holder. So any such income which is any distribution referred to in section 115 UA received by unit holder is exempt in their hand under section 1023 FD. So 1023 FC talks about the exemption to the unit to the business trust, and 1023 FD talks about the exemption to the unit holders, meaning these income will be taxable in the hands of business trust to the extent it does not comprise. So income so received by unit holders shall be exempt except the income of interest or dividend or rental in respect of property directly owned by the REIT. Okay, so about these three income, there is a pass-through. All other income is taxable in the hands of business trust. Section 115 UA provides that subject to provision section 11(1)(a) and 11(2), the total income of business trust shall be chargeable to tax at MMR. So the income which is taxable in the hands of business trust is taxable at the rate of MMR. One five UA3 says that and distributed income any part thereof, which is in the nature of interest, dividend. Which dividend? Dividend if the SPV has exercised the option under section 115BAA or rental income in respect of property directly owned by the REIT is deemed to be the income of unit holder in the previous year of distribution subject to the tax in the hands of unit holder. So what it says, interest and dividend. Which dividend? If the SPV has opted for 115BAA, the concessional tax, the new regime, and rental in respect of property directly owned by the REIT. Only these three income, except the other source income, is taxable in the hands of unit holder. Let's summarize. Okay. So the income is in the nature of transfer of listed unit of business trust by the unit holder. Okay. So unit holder is transferring the unit in the business trust. The income so right by it, if you know the business trust, units of business trust are covered by section 111A and 112A. So if the period of holding is more than 12 months, then it shall be long term, otherwise short term. The long term capital gain taxable under section 112A This is 12.5% excess of 1,25,000. In the short term, it's taxable under section 111A at the rate of 20%. Okay. In case of exchange of shares in SPV by sponsor for units of business trust. So what happens is that there's a sponsor which holds the share in SPV. Now it exchanges this share in SPV to the business trust, and business trust gives its unit to the sponsor. Now this exchange is exempt under section 47, is not treated as a transfer. And if this units are offloaded in the IPO, then it shall be taxable in the same way as it taxable in the case of promoter. In section 112A, 11A, as the case may be. For computing the capital gain, the cost of shares shall be deemed to be the cost of the unit holder units. The cost of units shall be deemed to be the cost of share, and the period for which shares are held shall also be taken into account. Now, interest income. This income shall be exempt in the hands of business trust and shall be taxable in the hands of unit holder. So, pass-through status. Interest income is not taxable in the hands of business trust, and SPV is not required to deduct tax at source on interest paid to business trust. Simple, because since the income is not taxable in the hands of business trust, the portion of TDS does not arise. The distributed income on any part thereof received by unit holder from REIT, which is in the nature of interest, is deemed as income of the unit holder. It shall be taxable in the hands of unit holder at the rate of 5% if the unit holder is non-resident, or at normal rates if it is resident. Business trust shall withhold tax at the rate of 5% if the unit holder is a non-resident, and 10% in case of resident. If business trust has obtained a loan from a non-resident in the form of ECB, exchange convertible bonds, then interest paid by the business trust shall be taxable in the hands of NR at the rate of 5% under section 194 LC, and business trust shall withhold tax at the rate of 5%. 194 LC is applicable if the money is borrowed in a foreign country from a source outside India under loan agreement from 1st July 12 to 30th June 2023, or under long-term bonds from 1st July 12 to 30th June 2023, or from issued RDB, rupee denominated bond, on or before 30th June 2023. However, if the loan is obtained by way of issue of long-term bond or RDB between 1st July 20 and 30th June 23, which is listed only on Economic Stock Exchange IFSC, then such interest shall be taxable at 4%. However, if the bonds are issued after 30th June 2023 and they are listed in IFSC, then the interest shall be taxable at the rate of 9%. And same amount shall be withheld by the business trust. So this was about the interest income on ECBs allotted or subscribed by the NR and issued by the business trust. Now dividend received by the business trust from SPV. The business trust is act as a pass-through status for dividend received by it, and business trust would be such dividend shall be exempt in the hands of business trust. Consequently, SPV is not required to withhold tax. Now, the unit holder shall receive this amount from the business trust. The unit holder shall be taxable only if the SPV has opted for concessional tax rate under section 105 BAA. The distributed income received by unit holder, which is in the nature of dividend, which received from SPV, which has exercised the option under section 115 BAA, is deemed as income of unit holder. If SPV has not exercised the option under section 115 BAA, then such dividend income is not taxable in the hands of unit holder and nor in the hands of business trust. The such dividend income shall be taxable at the rate of 10% in case of NR and normal rate in case of resident. And similarly, business trust shall withhold tax in the rate of 10% in case the recipient is NR, and again 10% in the case recipient is resident. Capital gain on disposal of asset by business trust. So this capital gain is accruing to the business trust and shall be taxable in the hands of business trust only. So capital gain is chargeable at the applicable rate in the hands of business trust. Now, if there is a long-term capital gain, then shall be taxable as per 112(112)(a). So capital gain referred to 111(a), short-term capital gain, shall be taxable as per the rate provided therein. Any other short-term capital gain shall be taxable at MMR, because we discussed that any income of business trust except 112(112)(a) or 111(a) is taxable at MMR. Okay. Such capital gain are further distributed to unit holder, and the component attributable to capital gain shall be exempt in the hands of unit holder. Why? Because business trust has paid tax on such income. Rental income from asset arising to REIT from the asset directly owned by it. This is a pass-through status. So any income business trust being REIT by way of rent from real estate asset directly owned by it is exempt in the hands of such REIT, because REIT is acting as a pass-through, and therefore the payer shall not withhold tax of the REIT, Section 184I, but such income shall be taxable in the hands of unit holder. Is deemed as income of the unit holder, and the REIT shall withhold tax at the 10% in case of resident and at not rate in force in case of non-resident. Then we came about the income of unit holder under ahead other sources. So this is the repayment of debt or redemption of unit holders. Such income shall be taxable in the hands of unit holder under the head other sources. Any other income business trust shall be taxable in the hands of business trust and shall be exempt in the hands of unit holder. Clear? Now let's see one example. This example will make you understand the concept very clearly. A business trust registered under SEBI as REIT gives you the following particulars of income for previous year 25-26. Interest income from Beta Limited 4 crore, dividend income from Beta Limited 2 crore, short-term capital gain on sale of listed shares of Beta Limited. These are the income of the REIT, not income of the unit holder. Short-term capital gain on sale of development properties 1 crore. Interest received from investment in unlisted debenture of real estate companies 10 lakh. Rental income from directly owned real estate asset 2.5 crore. Beta Limited is an Indian company in which the business trust holds 50% of shareholding. So Beta Limited is acting as a SPV. Discuss tax consequences of the above income earned by business trust in the hands of the business trust and the unit holder, assuming the business trust has distributed 10 crore to the unit holder in PY 25-26. Assume that Beta Limited does not opt to pay tax under Section 115BAA. If SPV has not opted to pay tax under Section 115BAA, then the dividend income shall neither be taxable in the hands of business trust nor in the hands of unit holder. See, dividend income is never taxable in the hands of business trust if received from SPV. And law says it shall be taxed in the hands of unit holder only when the SPV has opted for concessional tax regime. When dividend income is even otherwise not taxable in the hands of business trust, shall also not be taxable in the hands of unit holder, because SPV has paid tax at a higher rate on such dividend. Okay. Now first let's see what is the amount of income of business trust. 4 plus 2, 6, plus 1.5, 7.5, 8.5, 8.6, and 2.5. Mean 10, 11.1 CR is the total income. So whatever income is distributed, we will proportion the income in the ratio of 4:2:1.5 to 1:0.1:2.5 as the case may be. Now this interest income of 4 crore. It is exempt in the hands of business trust and taxable in the hands of unit holder. So whatever the amount the unit holder receive, it will proportion such amount the ratio of 4 divided by 11.1. Such amount shall be toward the interest and taxable in the hands of unit holder. Dividend 2 crore exempt in the hands of business trust and also exempt in the hands of unit holder. Why? Because SPV has not opted for concessional tax regime. Okay. Short-term capital gain on sale of listed share of Beta Limited, taxable in the hands of business trust and exempt in the hands of unit holder. Interest received from investment unlisted debenture of real estate companies 10 lakh. And lastly, rental income from the asset directly owned by REIT, again exempt in the hands of REIT and taxable in the hands of unit holder. Okay. So interest income of 4 crore. This would be no tax liability in the hands of business trust due to pass-through status. And therefore, Beta Limited is not required to deduct tax on this income. The distributed income received by unit holder, which is in the nature of interest, is deemed income in the hands of unit holder. And the business trust is required to withhold tax at the rate of 10% if the unit holder is a resident, and the rate of 5% in case unit holder is non-resident. So, dividend income distributed by SPV is exempt in the hands of business trust. Any distributed income referred to in section 105 UA, which is in the nature of dividend income received from SPV, in a case where SPV has exercised the option under section 105 BA, is taxable in the hands of unit holder. However, in this case, the SPV does not exercise the option of section 105 BAA. So dividend component is exempt in the hands of unit holder as well. Consequently, business trust shall not deduct tax. Short-term capital gain on sale of shares of SPV. Such short-term capital gain is liable to be taxed as 20% under section 105A in the hands of business trust. There would have been no tax liability on capital gain component of income distributed to unit holder by virtue of exemption. Claim under section 1023F. Short-term capital gain of 1 crore sale of development properties. It is taxable in the hands of business trust at MMR. There will be no tax liability on such income in the hands of unit holder. Interest of 10 lakh received in respect of investment in unlisted debenture of real estate entities. Such interest is also taxable at MMR in the hands of business trust. And there will be no tax liability in the hands of unit holder in respect of this income. Rental income 2.5 crore from asset directly owned by the REIT. Any income business trust being REIT by way of renting, of leasing, or letting out of property directly owned by it is exempt in the hands of trust, but it shall be taxable in the hands of unit holder, and the trust is liable to withhold tax on such payment. So if you see in case of business trust, only 3 incomes are taxable in the hands of unit holder, for which are exempt in the hands of business trust. What is interest received from SPV, dividend received from SPV if SPV opted for 115 BAA, and then rental income in respect of properties directly owned by REIT. Except these 3 income, all income are taxable in the hands of business trust and exempt in the hands of unit holder. Fine. In the case of unit holder, there is one more income which is taxable under section 56 to 12. This is redemption of units or repayment of debt, which is taxable in the hands of unit holder. Except these 3 income, all income is taxable in the hands of business trust. But there two more income which may be taxable in the hands of unit holder. One, income from transfer of units of business trust. So units of business trust are included in the section 111A and 112A. So if this is a long term, then such gain shall be taxable under section 112A at the rate of 12.5% in excess of rupees 1,25,000. If it is short term, such gains taxable under section 1A at the rate of 20%. Clear? Also, the income of business trust, except under section 111A, 112, 112A, is taxable at MMR. Okay. Now, one more income accrues to the unit holder, which is from exchange of shares in SPV in lieu of units in business trust. Such exchange is exempt, but at the time of sale of units of unit holder, the cost of units shall be deemed to be the cost of the shares in the SPV, and the period for which the shares were held shall also be taken into account while computing the period of holding for transfer of units. So very much logical. Clear? So today, what we discussed in depth charitable or religious organization, right? We discussed they are eligible for two regimes. First regime is under section 1023C and second regime is under section 11 and 12. First regime is about to expire, has already expired, means no fresh application can be made under first regime on or after 1st October 2024. Okay. Under section 11 and 12, the exemption is in respect of income applied for charitable religious purpose in India or outside India if approved by CBDT, by charitable organization, or in respect of corporate donation. The voluntary contribution received is also treated as income from property held under the trust. Okay. Then we discuss what is the procedure of registration, whether registration can be withdrawn or cancelled, the different types of income which is not allowed as deduction, circumstances where the exemption is not available. Then we discuss about the specified person and benefits being provided to specified person and tax implication thereof. Then we discuss about the special income taxable under section 115 BBI. Then we discuss about the anonymous donation taxable to 30% under section 115 BBC only in case of charitable organization, and it's not applicable in case of religious organization. In this case, we also discuss about the meaning of charitable purpose, the condition of trade, business, or commerce activity being applicable under the residual clause of advancement of object of general public utility. Okay. Then we discuss about the taxation of political party and electoral trust. All the income political party except in the head GBP exempt. However, political party is required to maintain books of account, get them audited, and furnish return of income. It must maintain a record of donor if the contribution is more than 20,000, and it cannot receive a contribution more than 2,000 in any mode other than the banking channel. Okay. Then we discuss about the electoral trust. They distribute 95% of their income to the political party, and they are required to maintain a statement of contributor and a statement which provides the name of the political party to whom the distribution is made. The amounts of voluntarily contributed to them is exempt in the hands of electoral trust. Then we discuss about the securitization trust and the investment fund. So all income of securitization trust is taxable in the hands of investor only and not taxable in the hand of securitization trust, meaning thereby the securitization trust is considered as pass-through in respect of all its income and is required to withhold tax on payment to its investor. If any amount is not paid by the securitization trust, it shall be deemed to have been paid on the last day of the previous year. However, it shall not again be treated as income of the unit holder or investor in the year in which it is actually received by it. Okay. The nature and the proportion of income in the hands of unit holder is the same as it is in the hands of securitization trust. Okay. Similar position there for investment fund. So investment fund is also treated as a pass-through entity in respect of all its income except income under PGPP. So the PGPP income is taxable in the hands of investment fund and it's exempt in the hands of unit holder. But all other income is exempt in the hands of investment fund but taxable in the hands of unit holder, and therefore unit holder is required to withhold tax on such amount. Then the loss arising to investment fund under the PGPP is allowed to the investment fund only. Any other loss shall be allowed to the unit holder only if the unit holder holds the unit for more than 12 months. Okay. Then we discuss about the business trust. Business trust are two types, REIT or InvIT. Following three incomes are exempt in the hand of business trust and taxable in the hand of unit holder, which is interest, dividend, and rental income from the asset that you own by the REIT. Dividend is exempt in the hand of business trust but taxable in the hand of unit holder only if the SPV has opted for concessional tax regime under Section 105 BAA. Otherwise, it is tax exempt in the hands of unit holder as well. All other asset income is taxable in the hands of business trust and exempt in the hand of unit holder. Such income, subject to Section 111A, 112A, or 112, is taxable in the hand of business trust at MMR. Okay. The unit holder may be taxed under other sources in respect of redemption of units or repayment of debt. Okay. Then, in case of unit holder transfer the unit of business trust, then the capital gain shall be taxable as short term or long term under Section 111A or 112A as the case may be. In case of exchange of shares for units of unit holder, such exchange is not considered as transfer, no capital gain. But on sale of units, the cost of units shall be deemed to be the cost of the share, and the period for which share was held shall also be considered while comparing the period of holding of the unit. Okay. So a simple chapter, but a very much scoring chapter. So this is a low-hanging fruit. You must do it very exhaustively because normally a question is being asked from this chapter. Okay. So we'll conclude our class now. Hope you will like it. We'll meet again in the next class. Thank you. Yes, sir. Good night.